Welcome to the latest edition of The Bull, the Bear, and You as we take a look at the economy and investing. I'm Stacy Smith, and with me today to talk about the economy and investing is my panel of experts, and they are Carrie Coghill of Coghill Investment Strategies here in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. I want to thank all of you once again for joining me for The Bull, the Bear, and You as we take a look at the economy and investing. So let us take a look at what has been happening in the markets, where they've been in the last 2 weeks since the last time we met, and where they possibly could be headed. Carrie, since the last time we met, the major indices have all moved upward, and all are now within a fraction of setting new all-time closing highs. Your thoughts about this?
I think it's just hard for people to actually accept the fact that the economy is doing well. Um, we kind of look at the numbers and we look at the run that we've had with the market, and people kind of forget that if you go back and look at market history, markets are every maybe 4 to 5 years we have a negative year. It's definitely more uncommon than common to have negative years in the market, but yet anytime we talk about the market, we talk about all the reasons why we think it's going to be going down. The problem that investors have is that it just doesn't happen in a straight line. So I do think that the economy is doing well. It doesn't mean that we're not going to face headwinds. We surely will at some point.
I think the reason people are so jaded, Carrie, is because the last three things we've lived through are COVID, which was a huge drop, '08, which was a massive one. And even though the dot-com bubble wasn't a big recession, technically speaking, from a stock market standpoint, particularly large cap growth and tech, and Kim can speak of this, that was just massive as well. So normal market pullbacks, which happen, as you mentioned, frequently, investors think that if you have a 5 to 10% correction, the shoe's about to drop and it's going to fall off to like 30 or 40% when the data really aren't indicating that. You pointed out that the economy is still doing pretty well. It's humming along. I'll be the first to admit that I'm very surprised that the market has been able to withstand rates this high. And, valuations are rather stretched too, but the economy does look to be pretty on solid ground.
If I can interrupt here just for a second, when you mentioned those three drops in the market, at least on two of them, there was a nice solid comeback. The last one with COVID, I mean, it was a very quick recovery. In '08, after we hit bottom, it moved up all the way through 2019 or 20, something like that. And then for the tech bubble burst, whatever you want to call it, that one took a couple of years for everything to start to right itself. Or am I wrong on that?
I think it did, but a lot of other stocks did better, right, than tech stocks. Tech stocks in that 2001, 2002 crash, they died the death they deserved, a lot of them, that they were either overpriced or a lot of the small names weren't really companies. People were just piling in and investing in
an idea.
An idea, right? And there was really nothing behind it. What I think people are really afraid of, and you're bringing this up, Stacy, is that the decline is not only going to go down and further down than where it is right at the moment when down is down, whatever that is, but they're really worried that it's going to be like the 10-year recession that happened in '29. And, we're running out of people that were alive in 1929, but we still look back and we're afraid of that. And I would say too, the '70s were an ugly time to be an investor for many reasons. And I think if you want to be a good investor, you look at times like that, but then you say, well, how are things different? And is this going to actually occur in the same way? There was a lot of regulation that happened in the '30s to make sure '29 would never happen again. And the '70s were an unusual time, which I think we could have a whole show on, like what went wrong in the '70s. And we could start with fashion. Fashion was horrible, but I get back on track. No, you always have to ask, what is different this time? And go from there, as opposed to just being fearful.
What we have going for us today, Stacy, is a couple of things. One is we have the three bills that Biden passed, the infrastructure bill and the CHIPS bill and the Inflation Reduction Act, all of which put a lot of money into the economy, are putting a lot of money into the economy. Throw in with that the AI explosion, which we have actual companies that make actual products that they actually sell, and the demand for their products is exceeding their capacity. So the chips bill is coming along at a very good time, actually, because factories are being built to equip people with these chips they need to do this all AI stuff. None of which I understand, but Kim will let you handle that. And that being said, there's a lot of tailwind there. The headwind is housing prices. I mean, that's just holding inflation up pretty much. And some think that the next headwind will be energy prices because there's not as much drilling and China's coming back a little bit. So the demand will start sucking some of that excess capacity off, and we'll see how that plays out.
Speaking of energy, very quickly, I'll throw this in on the CNBC on this Monday, May the 13th. There was someone who came on and said that the amount of energy that China is going to use is declining already because of the number of electric vehicles that are on the road. I found that kind of interesting.
So
Well,
I want to jump in here just to maybe, Michael, go back and forth a little bit on this. But the idea that interest rates are high, interest rates, in my opinion, are not high. Interest rates are normal. I think that they had been abnormally low for the past, couple decades or just a little shorter than that. But if you go back and look historically, where we are today is actually a very normal place to be. I think, to Michael's point, the reason why it's a headwind is really it's changed on the margin, right? It's that we were used to rates at a lower level, and now they're at a higher level. So, anytime you have a rate of change like that, you would expect some headwinds that we don't have. The other thing that I want to point out is that when we look at these major declines in the market, I think COVID was an interesting one, right? Because it kind of came out of nowhere and the implications of shutting down the economies and everything else. But we could still go back in time and look at what happened during the Spanish flu and how the dynamics of that played out. With, the 2008 crisis, for those of us that were, for some of us, let's say, that are in the profession, we knew that something was wrong. There were people out there that knew that the what was going on with subprime was something that was not going to end well for financial institutions in particular. And for us professional investments that are working directly with clients, what we did during that time is we got out of financials. Now, I didn't know things would blow up, obviously, to the extent that they did, but you could see it. And then you go back to Y2K. For those of us that were connected, you could see that these companies weren't making money and their valuations were really high. So, and again, correlating it to history, we have the same thing happened to the railroad companies in 1900, 1903. So, when we talk about investing and the value of having a professional person guide you, this is one of the values that we bring to the table. It's hard to understand what kind of investor to use, but I'll just throw that out there. I know that's something that we want to cover today.
Good.
I'll jump in there if you
Sure.
want. The first thing, yes, Carrie's right. We could see this stuff coming. I think the timing is everything in this, right? I mean, Alan Greenspan saw it coming in 1996, which was 4 years before the actual bubble burst. And if you'd gotten out then, I certainly wouldn't have had it. I wouldn't have a job. I think I would have been fired by every one of my clients had I done that. And then going back to Carrie's point on interest rates, yes, this is more normal from a longer term standpoint, without a doubt. And as we talked about before, I think it's the base effects or the base changes from where we were to now, which is a huge deal. And I would make the argument, Carrie, that it's not really normal for millennials and the Gen Zers, people who are maybe first time home buyers here, where interest rates have gone up quite a bit. They're the proverbial S out of luck in terms of trying to buy a new home with rates this high. But the big reason why I think the stock market hasn't fallen that much because of, or inflation hasn't come down that much because of the Fed raising rates, is because home prices being the biggest component of everybody's monthly bill, everybody has locked in a mortgage at incredibly low rates. And we talked about this a bunch. Nobody's really moving. It's not impacting anybody yet. So I think there's going to be more to be seen in terms of what the Fed needs to do to bring inflation down, because I still think it's a little bit stickier than most people anticipate.
All right.
And-
go ahead quickly.
Oh, wait, I want to touch on what you were saying about energy prices, Stacy.
Okay.
So we don't really recognize this a whole lot, but electricity generation in China is mainly coal. So what they're doing is they're going from internal combustion to coal, because if you're charging your car in China, it's not friendly energy, we'll just say. But, that's up to China to decide and the people that live there. But, any kind of lower demand from China on oil prices should allow prices to lower for the rest of the world.
Okay. We need to take a break. We'll be back in just a moment. Welcome back to our discussion about the economy and investing. All of you have stated, generally, the markets always do look ahead. We've just talked about how they rebound after even a recession. And if that is the case, and if speculation is correct at this moment, at least one rate cut is coming, according to those who speculate on these things, by the Fed. And that means that in all probability, the price of bonds will go down, or rather the price will go up, and the yield or the interest rate that bonds give will go down. I got it right? Price goes up, yield goes down. I mean, it's easy, but you get confused over it for whatever reason. So with that in mind, is now the time to try to lock in some sort of guaranteed income with those bonds? I mean, if the price is low and if indeed rate cuts are coming, would this be the time to do that?
Let me start with that, Stacy. Rates are not that high, so I don't think people should get too enthusiastic about extending their terms in order to make a capital gain in bonds. It's reasonable to extend it out from tomorrow's maturities and try to lock something in for a period of time. But I wouldn't be going out 30 years with too much money in this environment, because we just don't know what will happen going forward. And I don't think that the risk reward relationship to get 4.5 instead of 4.4 makes sense to take that kind of a risk. And that's where the longer bonds are, in the mid fours, depending on which maturity you're looking at. So yes, it makes sense to take some of the money out of money market funds, if that's where it is, and lock in the 4 or 5% return you can get, or go into the corporate side. Be careful, but go into the corporate side and maybe grab 5 or 6%. But be careful, because corporation things change. As Kim once said, bad things happen to good companies, and I've repeated it many times to many people. And that being said, yes, I suppose you can get a little more aggressive than we have been, but I wouldn't get too crazy about it yet, simply because I think these rates are just going to sit here for a while. Personally, I don't think they're going anywhere, much of anywhere, as Kerry tends to think. I think.
Anybody else on bonds?
When you're looking at bonds and should you be buying them and how much should you buy, it's very hard to look at that in isolation. When we look at different asset classes, whether it's bonds, whether it's stocks, whether it's commodities, you really have to look at what you're trying to accomplish as a client, as an investor, and what's the relationship between the different asset classes. And when you understand the components of an overall portfolio, then you can stress test it against things like interest rates going up or inflation going up. Because, the dynamics of why you own bonds is really as a separate asset class that can provide you with performance at times when other asset classes aren't performing. the idea that anyone thinks they know where interest rates is going is just, as you said, it's complete speculation. And, people that are saying, oh my gosh, I can go out and get a CD for 5%. Well, yeah, because inflation is high. So you're not making the kind of money that you think. There's a relationship between interest rates and inflation. And when you start to factor that inflation in, that's where generally, when you compare other asset classes like stocks, like bonds, great books written, Stocks for the Long Run, just the capital structure alone, lending versus investing, the market has outperformed. So it really comes back to a client's objectives and what their risk tolerance is.
I'll go to two things on that. One, just from a pure investment standpoint, the yield curve's inverted. I think rates stay probably a little bit higher for longer. I think the Fed cuts one time this year, Stacey, just to save face. They don't need to cut. They're just going to cut because they've been talking about they needed to cut a while ago. So they want to save face and do that. So if it were me, I'd probably stay a little bit shorter on the curve and get paid to wait a little bit. Only when you start to see unemployment go up quite a bit, which would signal the Fed drastically needs to cut more, is when I'd extend duration. That was point one. And then I had another point, which was going to be controversial, and I kind of forget it on my little diatribe there. So I'm going to let Kim jump in, and I'll think about it, and I'll come back.
Well, it's interesting. You talk about maybe one rate cut. Kim, many sessions ago, you made the point that you didn't think the Fed would make any rate cuts before the presidential election. You still feel that way?
I wish I did, but I don't. I think they're really determined to do one before. I know this is kind of crazy. I'm not somebody that is all conspiracy theory minded, but I see the other areas of the world that we need to pay attention to, which is China and the EU, and they're both hot to trot to cut rates. I think there is a political issue now with cutting rates, and that is if you don't own this economy, which is with the Republicans, like, first of all, I am apolitical in my job. It doesn't matter. And I go and vote, and who cares how I vote? I'm one person. But I'm just saying that the Democrats own this economy for good or for ill. And they have, America has really ramped up their debt. And a talking point for the opposition to the Democrats is that, in X days, we have $1 trillion worth of interest payments or $1 trillion worth of debt that has to be renewed. And I believe that everybody wants to be paying less interest on those instruments. So that is a little political push behind it. And again, not saying that, and that could be for the EU too. The EU has borrowed a lot of money. So just keep that in mind. So I think the Fed does want to do one or two by the even before the election. I thought they were going to try to stay steady, Eddie, but looks like they're not.
All right, we're going to go ahead.
What Kim just said, I'm not even sure that's political. That might be fiscal. They may be cutting rates just to help the Congress make the budget be not quite as bad.
Yeah, could be.
Okay.
Can I just say, this is why the Fed is supposed to be independent.
Mhm.
There's nothing more that, is so disappointing to me right now about how the Fed is dialoguing when they used to never dialogue in the past. We are talking about people's money here. And so for the Fed to have to, and I agree with what everyone is saying, for the Fed to have to save face or do it for budget reasons, we're talking about people's money. So I think the Fed has done a great disservice to this country by coming out and giving their dot plot of like, we anticipate reducing rates 7 times. It's not the way it used to be. And it's very disappointing.
All right, good. We'll take a quick break. We'll be back in just a moment. Let's talk a little more about something we briefly discussed before, and we kind of, Carrie brought it up earlier in this program, and that's working with a financial advisor. You have all been associated with smaller firms located in the city of Pittsburgh, but I have to pose this question. don't the bigger operations, the national firms, have more to offer a client just because of their size?
Sure. And they also charge more fees. I'll just lay that out there. Go to it, everyone.
And they also have more conflicts of interest because of their size.
Yeah.
I mean, it depends on what you want. It,
Those conflicts of interest are really significant, especially with the larger firms, because if you're working with a firm that has an investment banking branch and they're working on a major sale of something, or they know that one of their companies is buying another company, are their research analysts really going to come out and put a sell rating on that stock? I mean, I know that they talk about, their separation and all of that, but it's just a little too close for comfort for me.
I think the banks, they're fine. I mean, they do what they do, and they do it well. They have a good client base. What I tell some prospects when I meet with them, I say, look, what I do as a portfolio manager, what Carrie does, we do this for a living. In the end, your performance you get from me versus Carrie, I hope to outperform, obviously, but it's likely going to be somewhere in the ballpark there. As an advisor, you really want to find somebody that you just trust wholeheartedly with your assets, with your doing what is right by you and by your family and what you want to have done to meet your financial goals. I think that is really, really what it boils down to in the end.
Well, that raises a good question, because I know I made a little note on this one, and that is, how do you know that you can trust the financial advisor? I mean, the first time you meet them, what's the synergy that would be taking place or should be taking place?
as somebody who has left the business, let me say that what people, I believe, want from any of us is consistency, where we're coming out and we're giving the same advice this year, next year. And if anybody's been listening to this show when it was broadcast and now, I think that there's one thing that's pretty safe. We are really consistent. We say the same thing every week. And we might react to the news a little differently from moment to moment, but our message basically is put your money in a plan, in a game plan, and follow the game plan. Make adjustments as your life forces you to. The one that happens to everyone is they get older. So as you age, adjustments need to be made. Other things happen, some of them good, some of them bad, and that causes adjustments. And if you have a person who is consistent in their philosophy, and I know everyone on this show is, all right, you're down to who's going to perform better. I will say from my experience, Mike will perform better one year, Carrie will perform better another year, just because of the way they read the tea leaves, if you will. And sometimes they'll be right. Most of the time they'll be right, and occasionally they won't be. And that's just unfortunate, but it's human nature. We all have our day that we wonder what we were thinking.
Carrie, were you out there by yourself and with your firm just before the 2008 crash, if I can call it a crash, I guess, when you thought there was something wrong with the financials?
I was with another regional firm here in Pittsburgh. I left that firm in 2011, but it was still a small firm, right? So we didn't have any conflicts of interest when we wanted to reduce our exposure to financials because of what we saw coming. And it wasn't just us. I mean, there were books written about this stuff. There was a book called The $1 Trillion Meltdown that was all about this, that was written prior to 2008. It was then updated and the name was changed to the $3 trillion meltdown. So they didn't even know. But, I think when it comes to selecting a financial advisor, the best advice I can give to anyone is to get a referral from someone that you know and that you respect. If you know someone that's, working with an advisor, ask who they work with, and interview. You have to interview several different people. Ask for referrals. Now, obviously, anytime you ask for a referral, we're going to give you like the people that we think are going to speak most highly of us, but it gives you the opportunity to ask some specific questions. When it comes to performance, it rarely is about performance. And anyone that comes through our door and all they care about is performance, we tell them to go somewhere else, because our firm is based on accomplishing goals for our clients. It's not about how many percentage points we gained over the market. Buy an S&P 500 index fund, then you're guaranteed the results of the market. But if you can't deal with the volatility, or you're concerned about tax consequences and so forth, come to us. I would say that someone, for those of us who really take an asset allocation approach, as Michael said, our results are going to be similar. I would actually question the person that is more of the outlier. If we're up 15 and someone else is up 30, that makes me nervous, right? Because what goes up comes down. So you have to be pretty careful if you're just going based off performance. That's really not the reason why you need a financial advisor.
And even if you're going to select an asset manager, which is what we are, right? Because we advise, but if you want, but not really. Like my job is to run portfolios of equities. That being said, when you are chasing performance, beware, because you are going to get that performance, but you are probably not going to understand under what conditions it's not going to perform. And I would say some really savvy people have gotten burned, especially where there's leverage involved. And leverage can have names where, they're borrowing to accelerate the returns. That's one way that you can get multiples above the market. But there's also options contracts. And again, they rhyme with the underlying movements of the stocks that they represent, but not all the time. So these are very dangerous strategies that, yes, you can pursue. But I would say if you have goals, and none of this should be betting money, none of it. To work with an advisor, and they'll get you to the right mix of products or, philosophy that you can live with and that will protect your family.
How long does it take to come up with a plan for any client that you might have? A new one walks in the door.
Couple weeks. I mean, there's a process of, gathering the information, having a meeting where you gather the information, all of their statements, everything like that. And then we put it through an analysis and try to align our recommendations with their goals. Now, our firm, we do that work free of charge, because we feel that it's our investment into the process of gaining that client's trust and their business. I know there are other firms that charge a fee to do that work. They don't want to give it away for free because they're doing some work. And then maybe they would offset other fees if they come on board as a client. But, it's depending upon how busy we are, it's, a couple weeks.
Okay.
It also could depend on how complex the case is.
Mm-hmm.
You have somebody who has a lot of real estate and businesses and high net worth and estate issues and children issues, and you get into all sorts of rabbit holes in these situations. It causes it to take a little more time sometimes, because when it gets real complex, you might not have all the resources in-house, and you might have to go outside to get some information in order to do the job well. And because no one has all the resources inside, I mean, it wouldn't be efficient. And consequently, these things might take a little longer. It really depends on also depends on the complexity.
Yeah. And that's a really good point, because when it comes to, tax strategies, estate issues, business succession issues, those are things that can take months. So, when we're summarizing initially for a client, we're really going to identify all the things that need to be done and get done. The investment portfolio is generally the easiest piece of that. And then from there, we move on to make sure everything else is in line.
Okay. Well, thank you for joining me once again for the Bull, the Bear, and you. We'll continue our look at investing in the economy when we get together in about 2 weeks or so. But for right now, thanks for joining us, and we'll see you again in about 2 weeks. Bye.